Hello, everyone, and welcome to the Making Sense of Markets segment for quarter two, 2017. My name is Josh Kanan, and I'm one of the managing partners at Premier Wealth Advisors, and I'll be your host today for this segment along with my partner, Ari Crandall.
Hello, everybody.
This quarter, I noticed a variety of headlines focused on the active versus passive management debate and the higher frequency of those worried that too many investors were moving to a more passively managed vehicles. You see articles like from April 7th, passive investments far from perfect. April 17th is the passive indexing craze, the new tulip bulb mania. Passive investing is popular but ignores value, the hidden dangers of passive investing. Who's worried about passive investing? One quote really caught my eye from Forbes. Today's fad is index funds that track the Standard & Poor's 500. True, the average soundly beat most stock funds over the past decade, but is this an eternal truth or a transitory one? Well, it turns out that this quote was actually from 1990, Ari, and it's been that long that people have doubted that the trend away from active managers would persist.
Let's take a quick and highlight the difference between these two strategies, active and passive. Active managers have two things at their disposal. They can do market timing or stock picking. Passive managers believe in buying a diversified group of securities, and passive investments tend to be more tax efficient than active investments. Passive investment managers don't buy or sell as frequently as active managers, and frequent buying and selling has an impact on taxes. The question to ask yourself is, which of these two strategies gives you the best chance of getting those market returns that your plan is based on? The S&P Dow Jones SPIVA, which is the S&P Indices versus Active US scorecard, is published semi-annually. It's some 20 pages of hard-hitting data on active manager performance versus comparable market benchmarks. Here are some of the results of the latest SPIVA scorecard, and once again, the results don't look good for active managers. We've been longtime SPIVA fans. The first report was published about 13 years ago, and it quickly became our go-to active management scorecard.
You can see, Ari, just looking at that large cap funds 10-year numbers, only 15% of actively managed funds outperformed the benchmark over a 10-year stretch, only 15%. That's pretty darn impressive in terms of how these numbers are over the long term. And does past performance matter? The S&P Dow Jones team looked at 2,862 mutual funds that have been around for at least 12 months as of March 2010. They narrowed in on specifically US-oriented funds. If you looked at just the top quartile, the top 25%, and tracked their performance for the following 12-month periods going forward, you found that an amazingly small number of funds actually managed to achieve top quartile performance for those 5 successive years. Only 2 funds, or 0.07% of the original 2,862. By 2015, Ari, 0 remained in the top quartile.
You know, it's no surprise this happens all the time. We see these reports, you know, the top mutual funds to invest in. They're different ones every single year.
Absolutely. Well-known academic William Sharpe once spelled out the arithmetic of active management by saying, if active and passive management styles are defined in sensible ways, it must be the case that 1, before costs, the return on the average actively managed dollar will equal the return on the average passively managed dollar. And number 2, after costs, the return on the average actively managed dollar will be less than the return on the average passively managed dollar. So I think when he said that, Ari, Bill Sharpe, one of the famous economists, I think he definitely hit it right on the head.
Yeah, I mean, what we want to find if we're in an active strategy is we want to find value, and it's just proof over and over again that there typically is not additional value added in an active strategy.
Definitely over the long term.
One other thing we got to look at are, those 3 hurdles: the low odds of beating a benchmark, inability to persist with performance, and a lack of consistency in exposure. Those are leading significant dollars out of active management. Over the last 3 years through May, $650 billion has flown out of actively managed mutual funds and ETFs, while over $1.5 trillion has moved into passively managed investments. So 650 billion is a big number. We throw that number around a lot, and I always mention this in meetings with clients. Just keep in mind, $1 billion is 1,000 million. That is a lot of money. What might you look for in your investments? Real simple things: low turnover, broad diversification, low cash drag, low security sector or country concentration, consistent exposure to the desired areas of the market, and good value for the expenses paid. When you consider these factors for your investment vehicles, you can then spend more of your time making sure you're on track with your plan than worrying what stocks or mutual funds are going to quote unquote beat the market. Winners always stay diversified.
So I'm going to shift gears, Ari, and look at the performance from the second quarter. And I'll begin by looking at a macro view of performance around the globe. You know, returns often differ in stock markets around the world, and this quarter was certainly no exception. You look here as a snapshot of performance for the first quarter shows that the returns were positive in North America, but even higher in other regions around the world, partially due to a declining dollar, which we've been hearing about, which fell about 3.7% during the quarter. Returns in US dollars for the quarter look something like this. You had North America up about 2.8%, Europe, Middle East, and Africa rose 7.4%, and Asia tacked on 6.9% for the quarter. Meanwhile, Latin America was the only part of the globe to report negative performance, returning negative 1.7%.
So looking at the decline in the dollar, the decline in the dollar is a recent trend that has provided a tailwind for international US dollar denominated investment performance. For the first half of the year, the dollar has been the worst performing of all major currencies, down roughly 5.5%. As investors have been more bullish during the first half of the year on economic recoveries in Europe and other parts of the developing world, and fearful of the US slowdown, they have rushed to buy international currencies, and the dollar's declined. Their intent is to benefit from the potential higher interest rates in those countries. We'd like to remind investors that this is a recent trend. Just last year, the story was different. As the dollar strengthened against other major currencies, performance for international investments denominated in US dollars lagged that of performance in local currencies. International didn't do well in prior years. This year, it's doing great. Quarter two, currency impact on index performance. So this is really interesting. For dollar-denominated international investments, a weakening dollar has bolstered performance. The charts that you're looking at highlight the impact of weakening dollar on second quarter returns. Notice the difference in the second quarter returns for the MSCI World minus US index when denominated in local currency versus the US dollar. This currency impact resulted in a 330 basis points of outperformance for the dollar denominated index relative to the same index denominated in local currency.
Yeah, it's about 3.3% difference. That's significant. And I think like the previous slide said, Ari, it's just more of a recent trend. It's been the other way around for quite some time. As the dollar was strengthening, we were getting a drag on those international investments. And now the tides have turned. It's kind of similar to what President Trump talked about in his campaign, that he was going to push to a weaker dollar. And I think we're starting to see that. In general, during the quarter, we saw positive results for most asset classes, with large growth companies leading the way in the US markets and small growth leading the way in international markets. Looking back over the last 15 years, we see a similar trend. Both US and international stock markets rewarding investors who stayed invested, specifically in the small and value segments. In the US, a tilt towards small company stocks versus large company stocks has rewarded investors with a 15-year annual premium of 0.6% on average. However, investors tilted towards value versus growth have experienced relative annual underperformance of about 0.5% per year on average. Internationally, investors tilted towards small and value stocks captured average annual premiums of 3.8% and 0.6% respectively. In general, investors who stayed invested and followed our strategy of tilting their portfolios towards small cap and value companies both in the US and international allocations of their portfolios were rewarded with higher returns than a non-tilted portfolio over this period. Looking at the most recent quarter's asset class returns, and a lot of you have seen this chart before, we use it quite a bit, we call it our Skittles chart. We see asset classes in your portfolio ranging from 7.3% for international small cap, You can see that there. All the way down to, on the low end, 0.2% for cash. You can see what each of those asset classes did. If you maintain a diversified asset mix, such as the 65-35 mix, 65 stock, 35 bonds shown in white, it kept you away from the more extreme returns from year to year with significantly less volatility over the last 15 years, highlighting the importance of maintaining a well-diversified mix of asset classes in your portfolio.
You know, this slide's really great because it really drives home the point of the fact that winners always rotate. If you look at this chart, there is no pattern here. That's why we diversify.
Absolutely.
So following up on the effects of diversification on that 65-35 stock and bond mix on a portfolio, you can see that the largest contributors to that overall rate of return were U.S. large cap stocks and international large value stocks. Also, international small cap was a significant contributor. So that 0.46%, 0.6, 0.51%, those all add up and have a significant impact on overall return.
Thank you, everybody, for listening to our Making Sense of Markets presentation for the second quarter of 2017. And as always, if you have any questions about the economy, the markets, or your portfolio, don't hesitate to give us a call. Ari, do you have anything else you want to add?
We're always here to help. We're always here to answer questions. And just a reminder, if you do need to reach out to us, we're happy to take a phone call or answer email or questions. And as always, have an awesome day, and we'll catch you on the next one. Last thing, if you go on YouTube to the Loring Ward YouTube channel, you can find additional commentary and prior Making Sense of Markets information, and there's all sorts of stuff on there. So YouTube, Loring Ward videos, and you'll find some really good information.
Thank you, everybody. Bye-bye now.